Welcome to the Real Estate Asset Management Podcast, brought to you by Break of Day Capital. The show focuses on educating syndicators and apartment owners on how to build systems and manage their properties more efficiently to become a best-in-class operator. 100% straight talk. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Asset Management Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have Jens Nielsen. Jens is originally from Denmark, is a direct owner or GP in over 2,000 units, valued at over $250 million, and is a certified high-performance coach. Thanks for joining us, Jens. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, thanks, Gary. I'm super excited to be here today. So I don't know how deep you want to go. I'm originally from Denmark. It's been in this country for 26 years now, and retired from a long IT career about 2 years ago to fully immerse myself into real estate. Right, I live in beautiful sunny state of New Mexico, and but don't really. I have a few properties here, but a lot of it is kind of in the upper Midwest, and I really focus a lot on like underwriting, capital raising, and then asset management, which is probably the topic of today's conversation.
Absolutely, and I see that EOS book in the background. EOS is great. I'm sure it plays into your being a high performance coach. I assume in multifamily.
Yeah, the high performance coach is not necessarily specific multifamily. That's really just to help people to get clarity and energy and productivity in their lives, right? I mean, my clients are almost all into multifamily. Some are a residential agent, but they kind of is in that space, right? But it's not specifically to multifamily. It can help anybody that wants to improve their lives, really.
Well, awesome. Well, I'm glad to have you on the podcast, and wanted to talk to you about the evolving market. You've got interest rates going up, you've got labor issues, you've got inflation. So we'll jump into all of that and how you adapt and deal with it. Obviously, the successful people find a way to keep moving forward and see this as opportunity versus a time to just put your pencils down and out. So obviously rates have gone up, proceeds have fallen. How does that affect your underwriting, and what do you do to combat that?
Yeah, and I think I love what you started out saying, that people are putting their pencils down and waiting out, right? I mean, there's never going to be a perfect time to buy real estate, and I think as long as you stay in the game, right, if you conservative underwriting, you're gonna stay. You're gonna win, right? So I think as we've learned over these last few years, right, COVID hitting, interest rates going very low, but then everybody was afraid of buying during COVID. Now, occupancy is high and so forth, but now there's the interest rate challenge. So there's always going to be some challenges. I think what we look at, right, I mean, we continue to model in and try to find, actually, first of all, we are moving away from any kind of floating rate debt. We're trying to find fixed rate, even if it's higher, because at least we know our interest rate cost is fixed. Even if it's 7 or 8%, we can model it out versus a floating rate that God knows where it's going to go. We move to that. We've also gone to banks, right? Because with good relationship with banks, of course, you may have to go recourse. If you're okay with that, that's the risk you have to be, if you want to take it or not. But that's one thing that we've also looked towards, right? And then I feel like we can probably get a little bit of a discount now. I think I see some sellers that are starting to realize that, cap rates on 4 or 5 is not really going to work if you have a 6 or 7% interest rate. So if you want to sell, if you have to sell, if you need to sell, you may need to come down a little bit in price. So if all those things kind of work in your favor, the cash flow may be a little bit less. But I feel like if you can do that and then hopefully refinance in a couple of years into a lower interest rate, you're in a very good spot, right? So that's kind of what we're looking at right now. We've continued to buy. I mean, we bought like 4 or 5 deals this year, and we're looking at another larger deal right now. So there's still opportunity to be had for sure.
Yeah, I fully agree with you. Our last property we bought, we had a fixed 6.85%, which is really high, but there's no prepayment fee. There was very low fees. They're easy to work with on the draw. So it just made a lot of sense. And like you said, we can refi in a couple of years if we want to. We can sell if we want to. We bought the property at a 20% discount, and then I'm happy to pay 2% more on debt and get a 20% discount on the purchase without having to compete with anyone.
That's right.
Yep.
Yeah.
There's always opportunity in every market, and depending, and conditions too. And I think, people they all want a deal, but they want the perfect conditions.
Yeah, no, the same thing, right? I mean, during COVID, oh my God, what's going to happen? So nobody was buying. We continued to buy. Yeah, we had to come up with a lot of reserves, but those deals are awesome because they're like 3.5% interest rate, right? And nobody was competing. Now there's the opposite end, but a lot of competition has gone away as well, right? So I think there's going to be some shifts, but as long as you can stay in there and keep buying and it makes sense, I think that's the best place for your money. That's for sure.
Absolutely, absolutely. Obviously, inflation is one of the hottest topics for months now. How does it play a role in your deals and the properties that you're underwriting?
Yeah, I think the biggest challenge, I mean, we're just, we bought a deal in September of 21, 186 units that we've literally gone through 95% of them to renovate it. And the budget that we put together, a year and a half ago was a little slim compared to realities. I think the real challenge that we faced there was just tremendously long lead time on appliances, countertops, and other things. And also getting labor an issue was a huge challenge. Luckily, to the ingenuity of our kind of our partner to her at GC, she was able to pull together some really strong teams and really just start maybe scaling back and said, okay, this was the initial budget, which included maybe new cabinets. Well, unfortunately, for the same money, maybe we can't get cabinets. Maybe we have to paint them. Maybe we have to paint the countertop. So basically, instead of blowing out the budget, scaling down the work, and we feel like, a refinished cabinet door still going to get the same rent as a brand new one. Right? We're not doing Class A, so we just scale back a little bit to stay within the budget. Has been our thing. So we have just we struggled to build a team out the right contractors early in the year. That has now worked, so we have that. But we really have to be very intentional around ordering stuff, 60 days before we need it, and just managing the cost, right? So now when we're underwriting, we have to probably make the rehab cost 20% higher than we were a year ago, maybe, just to be realistic. And that's been a hard thing because suddenly, your capital raise has to be higher, or you got to get more money from your lender for the capex. So it does still impact the returns, right? We also have to be careful. We can't just say that rents are going to continue to go up at 7 or 10%, right? That's the other thing we have to be careful about. So there's definitely some adjustments in the underwriting there, and maybe also scaling back the investor's expectations that, hey, this could be a little bit slower, it could be a little bit of a longer hold, but would you rather have it in real estate or in the bank losing money? So
Yeah, we've definitely facing the same issues like you and everyone else. You've got you anytime you go to a store or a restaurant, they're understaffed, and at times we're understaffed too. So it hurts the productivity of our properties. Getting vendors out. That long lead time. We want to make sure we're on their calendar. Much earlier, even if we haven't 100% figured it out yet. Let's get them booked and get a bid, and this way at least we're not waiting multiple months. And things never go as fast as I'd like them to be, but I'm learning to push and be patient and do whatever, control what we can control, and then obviously anything we can't control, then so be it.
yeah, absolutely.
Yep. What other challenges are you facing in this market?
I think, maybe this is just the time of the year. It seems like here in the last few months, actually, leasing has slowed down significantly. I don't know if because we're pushing up against a top of the market in terms of rents, or there's just, a general people can't afford, they're doubling up with people, or they would rather go and get a unrenovated unit that's cheaper versus what we have to offer and stuff. So I feel like leasing has been a little bit slow here as we were speaking at the end of 22, right? And that may be a seasonal thing or whatever, but that's one thing that's, kind of we have to be careful about. So we kind of looking at the our underwriting and our projections for next year, because maybe, it's going to take us a little bit longer to get to that 95 plus occupancy, right? Maybe we got to scale back our rental increases and so forth. So I think that's the other one that we've struggled with a little bit. There's leasing and so forth. Beyond that, I think, now we have a great team in place, which has helped a lot with our turns and with our renovations. So that's been awesome. I think other markets in terms of taxes and insurance and all these other things that keep going up too, right? So that's definitely one of these things that we have to just adapt to the reality of what we're facing right now.
We face that same kind of wall as far as leasing up. It just really slowed down in our markets. I'm curious what you're doing with your renewals and your new leases. Are you lowering the your renewal rates and your rental rates, 25, 50? Are you being aggressive, or are you kind of just letting this time kind of subside, or what's your strategy?
Yeah, we've given the leasing agents some leeway there and said, okay, if you need to give a $50-$100 discount, get them in now versus waiting another month, because that money is then gone, right? We latest meeting this week, we talked about, why don't we offer like you full rent, but you get a $300 gift card to Home Depot. Sorry, not, I mean Best Buy or something like that, right? So you can go and buy your Christmas presents if you sign a lease in December or something like that. We're starting to add. I know a lot of people already do that, but add like internet, not free, but add that as part of the package. So that's in there and so forth. You just kind of finding new ways. A lot of our properties are Class Cs that don't have a lot of amenities, but we're trying to figure out what are some ways we can entice people. So definitely, here in the middle of December, it's not the best time to lease since we're in the upper Midwest, right? But just incentives, giving the leasing agent just some leeway to make the right decision to fill the units as quickly as possible.
Agreed. You don't want to slide back too far. You give it a couple of weeks, you make some tweaks, and if that's not working, make some more tweaks. And we certainly don't want to be at 100% occupied, but we also don't want to be really below 90%. And we've dipped on a couple and then got back up. But by doing slight tweaks and being creative too, well, maybe one thing works, maybe something else works at a different property. You've got to keep playing with it and seeing, and having that constant communication with your property management team to making sure you're being proactive and not falling too far behind.
Absolutely. Yep.
So, any other tricks of the trade that you're doing to deal with the challenges that we're facing right now, or underwriting, or anything else?
No, I mean, I think just setting the expectations with the property management company, with the leasing agents, with the general contractor. I mean, what are we trying to achieve, and also really share. I think sometimes you do the underwriting, you create a business plan, and you just don't necessarily. I see some people that never go and share that with the property management company, with the GC, and they're like, well, this is what we're trying to achieve with this budget. Help us get there, versus go and turn some units for us, and we'll see if we can lease them up at the dollar amount we want, right? So really just opening up that communication with everybody that's on the team, so we are all marching in the same direction, right? Because we're not an island, and the more information people have, the better chance of success we have. So I think that's really just the metrics and all these things that are really important for us to push forward there.
Absolutely. If you're going to make a bid on a property, I mean, I would advise you get your pro forma from your property management company. You don't want to have them underwrite a million different things, but if you're serious about something, making sure you're on the same page as your business plan. When you're in escrow, go over it again with all your vendors and making sure everything is aligned. And then when you take over, it's that constant. They're dealing with a lot of other properties. You want to make sure you guys are completely aligned on that business plan, and it'll pay huge dividends.
Absolutely, yeah, yeah, and we definitely because in the past we've made some mistakes around just making assumptions, oh, it's going to be 12 grand a door to turn them based upon historical data, right? Without really having that very in-depth conversation with the GC. And they're like, where do you get that number from, right? We weren't consulted. No, it's going to be 15. And we're like, oh, crap. Now we're, undercapitalized and so forth, right? So some of those mistakes, you definitely want to, I guess we all have to learn as we go through the process, but this is something that we want to get even away from. And I've even contemplated going in there and getting like a professional, almost like due diligence person to go in there and say, okay, what's the full thing? What's the full program here? I know it's going to cost money, but then, instead of me kind of like making assumptions, we actually have somebody that knows what they're doing and coming up with a budget that's realistic and we can meet.
Absolutely. Highly recommend it. So Jens, what is your asset management superpower?
Great question, Gary. I mean, I have, 27 plus years of IT experience, right? Managing IT projects and so forth. And I'm remote from all our properties, like hours of flight to get there. So I really spend a lot of time on setting metrics and managing to metrics, essentially, or scorecards. I mean, you see the US book behind me. I think the biggest takeaway there is like, what are the things that you're measuring, right? Making sure every single week we look at that and we manage that against our budget. So creating systems, managing the budgets, managing the scorecards and all those things. That's really what I'm good at. And holding people accountable to it, right? So we have our Asana and we got Slack channels and everything else. Putting systems in place, that's probably my my superpower.
I love it. I love it. Well, Jens, I appreciate you coming on the show and sharing your expertise on the challenges we're facing in today's market. Can you Can you tell the listeners where they can find out more about you and your company?
Absolutely. So my website is Open Doors with an S, opendoorscapital.com. My email is Jens, Jens at opendoorscapital.com. And if anybody wants to jump on a free call with me, they go to opendoorscapital.com/call, and anybody can book a 20-minute call to talk about, asset management or coaching, whatever if they're interested in.
Perfect. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Asset Management Podcast. Thanks, Jens.
Thank you.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and review this podcast, as it will help us grow our audience and reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website, breakofdaycapital.com, and sign up for our newsletter and or fill out our investor application. We'll talk to you next week.